China attracted less foreign direct investment in May compared with a year ago, according to new figures. Are foreign investors being put off by less favourable operating conditions in the world's second largest economy? With me to help explain what's going on is Steve Tsang from the China Policy Institute. Steve, foreign direct investment from the US has fallen by more than 11% over the past year. The fall has been even more dramatic with Japan, close to 47%. Why is this?
I think there are a variety of reasons. One of which is that the Chinese economy is slowing. The cost of manufacturing in China is rising. And there is a tendency for some manufacturers in the United States to reshore, which means that instead of simply trying to produce goods in China, they are looking at manufacturing back in the United States. There is also an issue of the Chinese government being much more assertive and making the investment environment in China less attractive. And the very strong anti-Japanese sentiments in Chinese society reflected in the dispute over the Diaoyu Senkaku Islands has made a lot of Japanese investors very uncomfortable, as some of the investments in China has suffered when feelings in China turned against Japan.
How vulnerable is FDI in China to the geopolitical situation? For example, the dispute over the islands in the East China Sea.
In general terms, foreign direct investments in China are not particularly vulnerable most of the time. What we are seeing is that under President Xi Jinping, there is more a sense that China must take charge, and therefore the kind of concessions and special arrangements made for foreign investments are likely to fall. In terms of the ramifications of the East China Sea dispute, that really mostly relates to the Japanese investments in China. Other countries are not generally affected by that.
The majority of new FDI in China is being directed at the services sector rather than manufacturing. How much of this is to do with the slowdown of the Chinese economy?
I think it is more a recognition of the foreign investment, seeing that they really need to be readjusting to the new environment for investment in China. At the end of the day, they are going to China to make profit. And if China is no longer quite as competitive as a manufacturing base, and yet with rising income in China itself, there is more of a domestic market in China, it simply makes sense for them to look also into the scope of providing services rather than simply producing cheap manufactured goods for export from China to the rest of the world.
Many thanks, Steve. Ben Jones will be taking a look at Japanese trade relations tomorrow. Goodbye.